Hello, everyone. This is John again from optionsmeister.com. And those of you that attended the Facebook Live the other day might recall that I had a technical glitch when I tried to share the screen. So hopefully I can correct that, get that under control before our next session this coming Wednesday. What I was at the point before the computer crashed of trying to explain how to use implied volatility and implied volatility rank and how they differ and why implied volatility rank is so important. So to that end, let me show you something. I want to pull a spreadsheet up that I use every day in my trading. This is what I call my OptionsMeister implied volatility rank, and it imports live data from Thinkorswim. Now I've got the market's closed now, but I've got Thinkorswim on it. It is importing live data. You're not seeing anything change. If it were during the trading hours, you'd be seeing these numbers changing. But it's a database of the 200 plus or minus 200 underlines that I typically trade. Now some will, companies merge, and some will go out of business or merge with another company or become, for some reason, they're not available to trade anymore. We'll remove those, and we're always looking to add new ones that come into play. Like, the last couple of years, we've had Facebook and Snap, and most recently Roku, Square. Some of those have been added. So, I want to do a real short video to show you why implied volatility rank is so important. First of all, if we're selling premium, we want to sell when implied volatility rank is high. Now, obviously, if implied volatility rank is high, implied volatility is going to be high. But let me show you something really important. Because before I knew anything about this, I would just always look at implied volatility. And I'm sorting, a couple of these cells aren't populating today, but I'm going to sort this thing from high to low. And think about this. We want to sell premium when it's high. So where we used to kind of draw the line in the sand at 50 IV rank, we'd sell above that and buy premium above that. Through Tasty Trades research over the last several years, that line's moved down, and I'm pretty much selling premium, kind of in the upper 20s and above. But more importantly, let me find a really good example here that I want to touch on. I've sorted this by implied volatility rank. For some reason, that's not sorting properly, but we'll get the gist here. I want to find one that's real low. Okay, let's look at this GOLD down here, where I've just kind of highlighted. Now you can see that the implied volatility rank on GOLD is 38. Is 53. The implied volatility is 38. But here's another underline where PBR, where the implied volatility is 38%. So you'd look at those and say, well, those are probably equal. Maybe I should sell premium both those. Well, the IV rank on that one is 15%. Now on this particular spreadsheet, I highlight the cells. That green is when they're below 20, 25, and then above 50, they're kind of that burnt orange color. So that shows you such a difference, such a dichotomy in what it really means. And now I've sorted the implied volatility from low to high. So I want to scroll down here and find some kind of an example that I can give you real easily on that may help you understand the difference. I want to find one that's really low. This is a close enough example. The implied volatility on VLO is 28%, 29%. So the implied volatility on Cisco is 29%. But what does that mean? What that is telling me is that Cisco has an IV rank of 51%. So a 30% implied volatility kind of represents that Cisco's right in the middle of its range. Now, because it has an applied volatility rank of over 50, we're going to be selling premium. We do credit spreads or condors or strangles or straddles or some type of short premium strategy on this particular underlying. So you'd say, well, let's look at up here at VLO as an example. Well, that's got about the same. That's got a 28% implied volatility. But look at the IV rank is only 18. So that means that even though it has the same implied volatility as Cisco, the implied volatility rank is so low, we wouldn't want to consider selling premium in that. In fact, we'd probably do a long premium, a directional type strategy. So if you could think of a scale of like 0 to or 1 to 100, your percentage, 100% at the high and 1% at the low, what the IV rank tells you is where the current implied volatility is in that scale from 1 to 100. So obviously, we could take two underlines with exactly the same implied volatility. One may be on the low end of the scale, one may be on the high end of the scale. So that's an important point that I wanted to get off, and we'll talk about that later if the questions come up in future Facebook Live. I'll be happy to help you, but I just wanted to kind of point that out because it's so important. A lot of people just take a look at implied volatility without putting it into context, because implied volatility is exactly what it says. That tells us what Cisco's got a 29%. Let's make the math easy. Say it's 30% implied volatility. It's currently traded for $50. That tells us the Cisco's got an expected range of $15 over the next year, plus 15, minus 15. So it's going to be somewhere between, what's that, 32 and 62, something in that range. So, and that's why it's so important to get your head wrapped around using the implied volatility rank, because now we go down to this something VLO, COP, any of these that have a very similar implied volatility rank, but it's telling you that represents the 28% represents that it's down here at the 21% on that 1 to 100 scale. It's way down at 21 for the same implied volatility. So that's a brief explanation, and I'd like to cover it in detail and look forward to any questions on that. Another thing to really point out too is, and I mentioned it in the Facebook Live the other day, is be really cognizant of the correlation to the SPX, or really any kind of correlation, because you don't want to have all your trades. You try to be diversified. You got 6 or 8 or 10 or 20 trades on. Or, you don't want to have them all in the same sector. That can be painful and not good for your financial health. Well, I hope this little short video helps. Please don't hesitate to ask questions. Type them in the comments. Look forward to seeing you again in the next Facebook Live Wednesday at 11 o'clock. Take care.